Hello everyone and welcome to my channel. This video continues with the 11th and penultimate part of the series. How does money and our global economic cycle work? It starts right after the intro. Stay tuned.
Insights for the informed investor.
The structure of consolidated financial statements. For investors, the income statement, balance sheet, and cash flow statement of a company are of crucial importance. In this chapter, you will learn all about these three key topics. You will also gain an insight into the structure of consolidated financial statements in accordance with IFRS. Before we delve deeper into the topic, one question needs to be clarified. What is IFRS anyway? IFRS is an abbreviation and actually stands for International Financial Reporting Standards. What does this mean? In concrete terms, this means that it specifies international regulations or rules for the accounting of commercial enterprises. The regulations were adopted by the International Accounting Standards Board, IASB. The aim is to harmonize accounting worldwide. In the case of IFRS, a decision should also be made. There are some companies that are obliged to prepare their financial statements and balance sheet in accordance with these standards. These companies are capital market-oriented companies. The term capital market-oriented is defined in this context by the fact that, for example, parent companies are admitted to trading on an organized capital market within the European Union. In addition to these companies, which are obliged to prepare their financial statements in accordance with international standards, other companies have the choice. If the capital market-oriented parent company does not operate within the framework described above, companies can still prepare their financial statements in accordance with IFRS. But what are the reasons for such accounting? There are a number of good reasons to prepare accounts in accordance with IFRS. The main objective of IFRS is to provide investors and creditors with important information that they can use for their activities. Experts are of the opinion that it can make sense for two types of companies to resort to accounting in accordance with IFRS guidelines. On the one hand, these are companies that see a prospective application in this accounting method. These include companies that want to raise capital on the market in the medium or long term. In this way, these companies can gain experience at an early stage, which can be useful in the further course of the company. On the other hand, competition for potential investors should not be excluded. Numerous companies are competing for investors to support their product or help them build the company. In this competition, it is crucial what information investors receive at what point in time. If only figures that are comparable at a national level are available, this can be disadvantageous for investors. As a rule, they have to compare numerous companies with one another. This gives rise to the following problem. How can a company from Germany be compared with other international companies if it only prepares its accounts in accordance with German law? This problem becomes more and more serious with increasing growth. Accordingly, it can make sense for many companies, especially in the technical sector, to prepare their accounts in accordance with IFRS. Now that you have learned what the basic requirements are, the next section of this chapter will focus on the annual and consolidated financial statements. What needs to be considered here, and how can a balance sheet be read correctly? A company's annual report usually contains the consolidated financial statements and the group management report. In addition to these two central components, some companies also attach the annual financial statements of the parent company. What is the difference between annual and consolidated financial statements? Do you know what the difference is between these two degrees? Choosing the right financial statements plays a decisive role in further analysis. If you look at a company's consolidated financial statements, you have the advantage of gaining a more comprehensive insight into the net assets, financial position, and results of operations. You also gain an insight into the company's cash flows. In contrast, the annual financial statements must be approved for each subsidiary group. This only reflects the economic situation of an individual company. The consolidated financial statements show the economic situation of an entire group of companies. In consolidated financial statements, the various companies in a group are thus presented in such a way that they are different group companies of a single company. The following is done to ensure that this can also be shown mathematically. The balance sheets and income statements of the subsidiaries and parent companies are added together. In addition, intra-group interrelationships, such as liabilities or sales revenue, are eliminated. Intercompany transactions are still included in the annual financial statements of a company. Why do the annual financial statements of a parent company not provide accurate information about the course of business? Before the individual components of consolidated financial statements are explained, the above question should first be addressed. This is because many investors are unaware that the parent company of a group is generally not directly active on the market. The operating results of the parent company are generated by the various subsidiaries. In later years, distributions may then be made to the parent company. This makes one aspect clear. The parent company does not reflect the result generated in a period. It must be ensured that all results are consolidated. This ultimately ensures that a true reflection of the group or group of companies is created. The components of the IFRS consolidated financial statements. Consolidated financial statements in accordance with IFRS have different components. The balance sheet, the statement of comprehensive income, the cash flow statement, and the notes are among the main components. The management report is not a required component under IFRS. But what does a company's management report contain? The management report takes on a strongly verbal role. As a rule, it is a management report. In the management report, the course of business is recorded alongside the situation of the group. In addition, such a report presents the expected development of the company. All risks and opportunities are presented so that investors can gain a clear picture of the company's situation. While the other components of the consolidated financial statements only look at the actual situation, the management report goes a little further. The annual report and the consolidated financial statements. The annual report fulfills one purpose. It presents the company in question to the interested public. The scope and structure of this report are not prescribed by law. However, the annual report usually contains the consolidated financial statements and the group management report. The IFRS regulations and the requirements of commercial law apply to these two instruments. The content and formal structure must be based on these two regulations. Once the annual financial statements have been completed, they are usually audited by the auditor. The auditor's opinion usually relates to the consolidated financial statements and the group management report. The annual report, therefore, contains aspects that are standardized by law, as well as aspects that can be freely designed by the company. The following section focuses on the consolidated financial statements and the group management report. The Statement of Comprehensive Income. The Statement of Comprehensive Income provides an insight into the business success of the company. The IFRS income statement is a two-part statement. In addition to the respective profit or loss for a period, other comprehensive income is also shown. If both components are added together, the result is the so-called total comprehensive income. This total comprehensive income therefore includes all profits and losses generated in a financial year. If the changes in equity are now added to this total comprehensive income, this means that the total changes in equity can be shown. According to IFRS, total comprehensive income can be presented in various ways. For example, it can be a component of the financial statements. In this case, both the profit and the loss are merely an intermediate figure. After the profit or loss, other comprehensive income is then illustrated. In this way, the sum of both results can ultimately be shown. An alternative method of presentation is as follows. The overall result is illustrated in two financial statement components. In this case, there are also two different statements. The first statement, the profit and loss account, shows all expenses and income. It therefore always ends with the respective profit or loss of a company in a corresponding period. This statement is followed by a second statement that shows the overall result, taking into account other results. This second calculation is then the consolidated statement of comprehensive income. In practice, you will find both variants. The terms for the respective financial statement components and the designation of the components can be chosen by each company. These, therefore, also differ greatly in practice. The profit or loss is therefore not described as such, but rather as the annual result. In addition to this term, the term profit-loss for the period or net income is also used in practice. Now that the consolidated statement of comprehensive income has been discussed in detail, the presentation of other comprehensive income will be illustrated. This should also be presented in two subcomponents. The first group is represented by all those items that are never reclassified to profit or loss. The second group, on the other hand, consists of all those items that can be reclassified to profit or loss under certain circumstances. The IFRS standards form the guidelines for this. They describe which income and expenses are included in profit or loss, the difference between profit-loss and other comprehensive income. As already mentioned, the IFRS standards specify which income and which expenses are to be recognized in profit or loss. They also specify which amounts must be recognized in other comprehensive income. In practice, this repeatedly leads to ambiguities. In order to avoid this, an attempt has been made to explain this. This describes that the profit or loss is essentially the profit contribution from central business activities. This result can therefore also be interpreted in another way. It indicates the performance of the business model. In order for a business model to be implemented, management must primarily make operational but also financial decisions. Accordingly, the result for the period is voluntarily divided into an operating result and a financial result. Other comprehensive income only includes changes in value, such as those of assets or liabilities. These changes in value result from changes in market data. What characterizes these changes? They are characterized by the central aspect that they are not cash effective in the first instance. It is therefore not possible to predict when these changes will lead to an inflow or outflow of cash for a group over time. The pension provision should be taken as an example here. An increase in this figure would result in a negative effect being recognized in other comprehensive income. However, payments will only be made at a later date, which will have a significant impact on business activities. The tax effects of other comprehensive income also follow a certain pattern. The deferred taxes of the individual items of other comprehensive income are either included directly in the statement of comprehensive income or alternatively disclosed in the notes to the consolidated financial statements. If you've enjoyed the video so far, don't forget to like it. Subscribe to my channel and activate the bell to give the channel added value and support my channel for free. How reliable is the overall result? This is a crucial question that plays a decisive role, especially before a possible investment in a company. As a first step, it should be noted that the income statement according to IFRS, like that according to German commercial law, is not based on measurable receipts and payments. Estimates are required for a large number of existing items, which means that the values stated can also be subject to errors. This problem is already evident in the initial figure in the income statement. This is because sales revenue is not only defined as the cash inflow from the sale of goods and services. Revenue may also have been generated in other ways that cannot be represented accordingly. Accordingly, care is taken in an estimate to ensure that revenue is recognized upstream. Ultimately, this ensures that potential sales revenues that lead to cash inflows at a later date are recognized in the period in which they would actually have been generated. This is merely an example of the fact that expenses and income are based on a large number of assumptions about future events. You should therefore be aware that these estimated figures may also be revised in the next period. These estimates, which are subject to risk, can pose a problem. However, the notes to the consolidated financial statements always include a report on which estimates have been revised and how this was achieved. The aim is to provide investors with transparency about the extent to which the company's earnings have fallen or risen. At this point, a crucial question arises. How can the reliability of the results be determined? The reliability of the results. How should a company make it clear that the stated results are truly reliable? To enable the reader to assess the extent of the valuation uncertainties, the notes to the consolidated financial statements contain a great deal of information on the valuation standards used. For example, if fair values are estimated as present values, the notes also contain the underlying standards. This applies in particular to the interest rate used for the estimate. Accordingly, one thing is certain: a look at the notes is essential. You should get an overview of the contents of the notes so that you can correctly classify the results of a group. This will ultimately ensure that you obtain a reasonable, realistic picture of the result. The structure of the income statement. The structure of the profit and loss account plays a decisive role. There are two different approaches: the cost of sales method and the nature of expense method. In the total cost method, the total performance of the respective period is shown. In addition to sales revenue, services that could not yet be sold in the respective period are also shown. These services may include changes in inventories or own work capitalized. The total operating performance is then compared with the expenses in the financial period. The cost of sales method uses a different procedure to illustrate the result. In this method, the first step is to compare the services rendered or sales revenue with the cost of sales. It does not matter in which financial year the cost of sales was incurred. Accordingly, there are differences, for example, in the case of goods that were manufactured for stock. Another difference arises from the fact that expenses are classified differently. In the total cost method, it is common for all expenses to be broken down by corresponding expense types. For example, there is the cost of materials or personnel expenses. In the cost of sales method, there are no different types according to which expenses are classified. On the contrary, care is taken to ensure that sales revenues are directly compared with the cost of sales. There is one advantage to this approach. This is that the gross margin can be calculated directly from the subtotal, the gross profit. How do you get a quick insight? This is one of the most crucial points. After all, you want to read the financial statements and get a direct insight into the course of business. What is the best way to do this? If the management report doesn't tell you anything at first or is too complex, you can take a look at the earnings performance for an initial insight. The earnings performance shows how successful a particular group has been with a business model. Another important aspect is that you gain an insight into all operating results. A group's competitors are also analyzed. At this point, reference should of course also be made to the earnings statement. How sustainable is this at all? To do this, you need to understand how good results are achieved. Based on the information in the notes and with the help of interviews with management, analysts try to determine a pure annual result. This annual result should not include any one-off events or transactions, or extraordinary expenses or income. This forms the basis for an adequate company valuation. This can then be used to arrive at a reasonable valuation of the share. All income and expenses reported should have been caused by the company's business activities. There are some companies that meet the needs of analysts by reporting subtotals. However, the disclosure of different figures is restricted by the different sets of rules. For example, restructuring measures cannot be reported separately under the cost of sales method. This represents an obstacle for some companies. This is because restructuring measures are allocated to research, development, and production under the cost of sales method. So how are analysts supposed to obtain a pure annual result? It's not that simple. Here, one resorts to the words of the management or simply to estimates. Three key figures play a major role in analyzing a company's earnings: EBIT, EBITDA, and EBITDA. If you like the video, please give me a like, subscribe to the channel, and activate the bell so you don't miss any new videos. Thank you for watching the whole video, and see you soon.